In the vast ocean of the stock market, where waves of information crash down relentlessly, how does one find the lighthouse of true value? Today, we're setting sail into the world of fundamental analysis. Think of it as the compass that navigates investors through seas of market speculation and helps investors to find real value. The roots of fundamental analysis stretch back to the early 20th century with the legendary investors Benjamin Graham and David Todd. They introduced this meticulous approach in their 1934 classic Security Analysis, laying a foundation that would guide countless investors towards a more rational, value-driven approach in investing. Fundamental analysis allows investors to navigate the market's volatility, identify undervalued stocks, and make decisions based on a company's true value rather than speculative trends. It's about investing with conviction in what you know about a business's fundamentals. Now let's go into the 5 key components of fundamental investing which are crucial for any long-term investor. First, we have earnings and revenue growth. These are the lifeblood of any company, indicating not just current health but potential for future expansion as well. Consistent growth suggests a business is doing something right. From innovating to capturing market share, this can be seen by looking at the company's earning reports. A good annual growth rate can vary from sector to sector due to different factors. However, a general benchmark is a growth rate of over 7 to 8%. However, this should be much higher for stocks and sectors such as tech, which are growing much faster than the general market, and lower in sectors such as mining, which are much slower than the general market. Next, we have profitability ratios. These figures, including return on equity and return on assets, give us insight into how efficiently a company converts its assets into profits. A higher ROE indicates a company is using its investments effectively to generate earnings. A good ROE for technology firms might be 15% or higher, reflecting their asset-light models. Whereas for manufacturing, a 10 to 12% ROE could be considered strong as well, due to their capital-intensive nature. It's about understanding the efficiency of a company in generating profits relative to its equity and assets, within the context of its industry as well. Next, we have debt levels. While debt can fuel growth, excessive debt may jeopardize a company's financial stability. We scrutinize the debt to equity ratio, seeking firms that maintain a healthy balance between borrowing and their own capital. A debt to equity ratio below 1 is generally favorable, as it means that their debt is lower than their shareholder equity. But this can differ. For instance, in capital heavy industries like utilities or real estate, a higher ratio is more acceptable, often exceeding 1.5. The key is to see companies managing their debt wisely compared to their sector peers. Now, we look at the price to earnings ratio. The price to earnings ratio, or PE, helps us to gauge market expectations. It compares the company's share price to its earnings per share. A lower PE might suggest a stock is undervalued, offering potentially lucrative opportunities for investors. PE ratios can vary massively across sectors and companies. High growth industries like tech might have higher average PEs, with many big companies having a PE ratio of above 50, reflecting future growth expectations. More stable sectors, however, like consumer staples, might have an average PE of 15 to 20. A good PE can only be decided in relation to the average PE of the sector and growth expectation. Finally, we have market position and competitive advantage. This involves understanding how a company stands out in its industry, be it through innovation, brand strength, or market share. A strong position often equates to sustainable success. Assessing market position and competitive advantage doesn't come down to numbers but to qualitative analysis. Here, we look for leadership, brand strength, proprietary technology, or cost advantages. To understand this, looking into the news about the company and its leadership can be helpful, along with analyzing its moat, which is its competitive advantage. In fundamental analysis, understanding the numbers is just the beginning. Context is everything. What's considered healthy or promising varies by sector and stock type. By comparing companies within their industries and against sector benchmarks, investors can identify those truly poised for success. Armed with these insights, you are now better equipped to navigate the complex tapestry of the stock market. In our upcoming videos, we will go into further detail about certain ratios, fundamental analysis, and also look into technical analysis.